If you like saving money on taxes, then you need to know how this rule called the step up in basis works. Basis adjustment is a tax provision that you'll want to pay special attention to, whether you're expecting to receive inheritance or just creating your own estate plan. So, in today's video, I'm going to tell you everything you need to know about the step up in basis and how to use it to your advantage to save money on taxes. And don't forget to stick around until the end of this video where I go through a real world example using the step up in basis rule you're not going to want to miss. So let's get into it. Alright guys, before we dive in, make sure you smash that subscribe button for real strategies from an IRS enrolled agent and financial planner to help you lower taxes and invest smarter. Alright, first, let's make sure we're on the same page about what step up in basis actually is. And your basis is basically what you paid for an asset. So in this example, if your dad bought, let's say, a beach house in California in 1980 for $100,000, which is your basis, and later sold it for $800,000, he'd have a $700,000 capital gain, and Uncle Sam wants his cut. And just a quick refresher, gains you make from selling assets you've held for a year or less are called short-term capital gains. And generally, they're taxed at the same rate as your ordinary income, anywhere from 10% all the way up to 37%. And gains from the sale of assets you've held for longer than a year are known as long-term capital gains. And they're typically taxed at lower rates than short-term gains in ordinary income, at either 0%, 15%, or 20%, depending on your taxable income. But here's the twist. When your dad passes away, most assets get what's called a step up in basis. That means if you inherit those assets, the IRS allows the cost basis to reset to the current market value, wiping out those unrealized gains from dear old dad. So, from the example that we just used, if your dad bought that same beach house for $100,000 and it was worth $800,000 on the day that he passed away after a long life and leaving it to you, your basis would now be that $800,000, not your dad's original $100,000 basis. And in effect, wiping out any capital gains on that $700,000 of appreciation. So from a tax standpoint, it's treated as though you bought the beach house at its value on the date of his death. So any unrealized gains from your father before that point are not taxable. You could then turn around and sell that beach house right away if you wanted to, and you would owe $0 in capital gains on that $800,000. However, if you decided to keep the beach house for a few years and then it went up again in value to $900,000, you'd owe a long-term capital gain on the $100,000 difference. And it's important to note that the step up in basis provision doesn't apply to just real estate, but to various types of financial assets and tangible property, including stocks, digital assets, bonds, mutual funds, real estate, and more. However, the step up in basis treatment does not apply to IRAs, 401ks, pensions, tax deferred annuities, or gifted assets. And this last one is so important because I often hear folks say that they want to gift or transfer their home or other assets to their kids before they die. And this can be a costly mistake. Going back to Dad's beach house, if he gifted that property to you before he passed away, your basis would be his original $100,000 basis, not the $800,000 stepped up basis. So in other words, if you sold his property after he passed, you'd owe capital gains on $700,000 versus the $0 you'd owe with the stepped up basis treatment. And if you're in the 20% capital gains bracket, you'd owe a whopping $140,000 in taxes if he gifted that property to you. Yikes. And imagine if you didn't know about this rule and had to pay $140,000 when you could have paid nothing. And this is why it's so important to work with a tax professional that can help you with these rules like step up and basis, because we can help you avoid a potentially massive tax bill on highly appreciated assets you might receive as an inheritance that you obviously don't want to pay taxes on, right? The step up in basis can also help you plan how to best pass on assets like stocks or bonds or real estate to loved ones without leaving them with a large surprise tax bill they won't know how to deal with. And if you want to pass on assets to family members or receive an inheritance, you need to know how these things work so you can use them to your advantage. And this stuff isn't just for the wealthy, which is why I'm showing you these strategies so you too can legally reduce how much tax you send to the government. But you need to plan ahead. So let's look at a real world example of how we use strategic planning with step up and basis to save our clients some serious money. All right, consider the simplified version of this scenario I encountered. Tom and Sandy are married and live in a common law state. They have investments in a joint account with $500,000 in long-term capital gains and $40,000 in capital losses. Tom's been managing this account himself for years. Unfortunately, Tom's been diagnosed with cancer and only given 2 or 3 years to live. And he came to us because he wanted to set Sandy up for success when he's gone. And in this situation, there's really only 2 options. The first is do nothing. And if they didn't change anything, when Tom passes, Sandy would only get the step up and basis on half of the gains in the joint account, and the other $250,000 would be taxable when sold. She would also only retain $20,000 in losses to offset any future gains. And option 2, which is the better option, is to restructure their accounts. And we started by transferring the appreciated assets to an account in Tom's name only, and then transferred the loss positions to an individual account in Sandy's name only. This creates a situation where after Tom's passing, Sandy receives the full step up in basis on the $500,000 gain position, meaning she can sell them tax-free. Sandy also retained the $40,000 in losses to offset any future capital gains. But like I mentioned before, timing is everything, and these assets must be held for 1 year to qualify for the step up in basis. And this rule is just meant to stop families from giving assets to someone right before they die just to get them back soon after with a stepped up basis. So while moving appreciated assets to the account of the spouse expected to pass first can be effective if done well in advance, it doesn't work when death happens suddenly or with little warning. This simple planning saved Sandy tens of thousands of dollars in future taxes compared to doing nothing and paying way more than legally required to the IRS. Step up in basis is just one of the many things you should be taking advantage of if you want to save as much money on your taxes as possible. One of the most important things we do as tax strategists and financial planners is to not just take into account your goals right now, but also your long-term goals so we can structure your tax plan to best serve you now and in the future. This can make a huge difference in your lifetime tax savings versus potentially paying more than necessary to our greedy Uncle Sam. If you're looking for additional information around inheriting assets, step up in basis, or how to best structure your tax write-offs, feel free to schedule a consultation by clicking the link in my bio. See you on the next one.